Good morning, ladies and gentlemen of the media, and welcome to the press briefing for the 115th Monetary Policy Committee meetings, which took place last week. This is actually the last monetary policy press event for 2023. The committee deliberated on global and domestic macroeconomic developments, including assessment of the performance of the economy and the risks to the outlook for inflation. A summary of the assessments and key considerations that inform the committee's decision on the positioning of the monetary policy rate follows. Global economic activity improved in the first half of the year, but continued weakness in the manufacturing sector and moderation in the services sector linger. These conditions, coupled with weakening consumer and business confidence, especially in advanced economies, have moderated the pace of recovery in global growth. In addition, the observed growth rebound in China in the third quarter has slowed down, reflecting deflation concerns and persistent contraction in the property market, and has weakened growth prospects. In view of these developments, the October 2023 IMF World Economic Outlook projects global growth at 3% in 2023 and 2.9% in 2024, down from 3.5% in 2022. For emerging market and developing economies, growth is projected to remain stable at 4% in both 2023 and 2024. Global headline inflation remains on a downward trajectory, largely supported by the decline in energy and food prices. However, the pace of disinflation has slowed down, underscored by still tight labor markets across advanced economies. Longer-term inflation expectations, however, remain anchored, reflecting the continued tightening policy stance of central banks and the recent trend declines in headline and core inflation. In the outlook, the gradual disinflation process should continue as the effects of tighter monetary policy passes through to core inflation. Global financing conditions remain tight, reflecting the tight monetary policy stance globally. Most central banks expect policy rates to remain high for longer to fully dampen inflation pressures. As a result, long-term bond yields remain high. Meanwhile, EMDEs have continued to face high borrowing costs amid high long-term bond yields and elevated sovereign spreads. At the same time, lending standards have tightened and loan demand has dropped in advanced economies. There are, however, emerging signs of recovery in the equity markets, supported by the expectation that central banks in advanced economies have reached the peak of their tightening cycle, while outflows from EMDEs have declined sharply. Economic activity domestically continued to recover beyond the first half of the year. After recording an average real GDP growth of 3.2% in the first half of the year, indications are that growth is still firming up. In the third quarter, the bank's high-frequency real sector indicators pointed to continued pickup in economic activity, although at a moderate pace. The updated composite index of economic activity contracted at a lower rate of 0.4% in September 2023, compared with a sharper contraction of 1.2% in the same period of last year. The main indicators that contributed to the relative improvement in the CIEA were industrial consumption of electricity, private sector contributions to social security, and tourist arrivals. The momentum in credit to the private sector, cement sales, and port activity, however, slowed down over the period. The bank's confidence surveys conducted in October 2023 reflected emerging positive sentiments about the economy. The Business Confidence Index improved as firms met their short-term targets and expressed optimism about business prospects, while Consumer Confidence Index remained generally unchanged and stable over the August survey. Also, Ghana's Purchasing Managers Index for October 2023 was at 50.5, unchanged from the previous month's level. Inflationary pressures continue to ease in line with the tighter monetary policy stance. In October 2023, headline inflation declined to 35.2%, further down from 38.1% in September and 40.1% in August 2023. These trends were supported by broad-based deceleration in prices of items in the consumer basket. The decline in October's inflation was driven by both food and non-food prices. Food inflation declined to 44.8% in October 2023 from 49.3% in September, while non-food inflation eased further to 27.7% from 29.3% over the same comparative period. Core inflation has also eased significantly, reinforcing the broad deceleration in prices. All core inflation measures monitored by the bank declined, with the bank's main core inflation measure, which excludes energy and utility, decelerating to 36.2% in October from 39% in September and 41% in August 2023. Similarly, inflation expectations of banks, consumers, and businesses all eased in October 2023. Fiscal policy implementation for the first half of the year has been in line with the performance criteria under the IMF ECF supported program. The targets on the primary fiscal balance on commitment basis, non-accumulation of external debt payment arrears, and newly collateralized debt by central government and public entities were all attained. Fiscal performance based on the narrow budget shows a deficit of 2.9% of GDP for the period January to October 2023 against a target of 5.1% of GDP. The pace of growth in monetary aggregates has significantly slowed, underpinned by tight liquidity management. Reserve money contracted by 2.6% on a year-on-year basis in October compared to an increase of 62% recorded for the same period in 2022. The significant contraction in reserve money was on the back of strict adherence to zero financing of the budget and sustained liquidity withdrawal efforts of about 44.9 billion Ghana cedis. As a result of these, broad money supply growth declined to 20.4% in October 2023, relative to 45.2% in October 2022. Credit to the private sector contracted during the review period. Banks continue to deploy their resources towards short-term investments as opposed to extension of credit in response to the increased risks associated with lending following deteriorating macroeconomic conditions and the impact of the domestic debt exchange program. Private sector credit contracted by 7.5% in October 2023 compared with 57.3% growth recorded in October 2022. In real terms, credit to the private sector contracted significantly by 31.6% relative to a growth of 3% recorded over the same comparative period. On the money market, interest rates broadly tightened at the short end of the yield curve. The 91-day and 182-day Treasury bill rates fell marginally to 29.4% and 31.37% respectively in October 2023, from 31.5% and 32.6% respectively in October 2022. The rate on the 364-day instrument, however, increased to 33.16% from 32.32% over the same period. The interbank weighted average rate, that is the rate at which banks lend among themselves, increased to align with the policy corridor. The weighted average rate increased to 28.49% in October 2023 from 23.98% in October 2022, in line with movements in the monetary policy rate and an increase in the cash reserve ratio. This led to an improvement in the policy transmission, as the average lending rates of banks increased to 32.6% in October 2023 from 31.4% in the corresponding period of 2022. The banking sector remains stable, sound, liquid, and profitable, even as banks continue to adjust to the impact of the DDEP. The sector's capital adequacy levels remained above the minimum regulatory level with regulatory reliefs, with most banks carrying excess liquidity. The industry's NPL ratio increased to 18.3% in October 2023 from 14% in October 2022 and 15.7% in January 2023, reflecting elevated credit risk associated with the effects of the macroeconomic crisis of 2022. Profitability continues to improve as banks continue to invest in high-yielding, short-dated Bank of Ghana and Government of Ghana instruments. The banking sector showed some resilience as the various stress tests on bank capital following adverse macroeconomic shocks pointed to stability. Developments on the international commodity markets showed that prices of Ghana's major export commodities recorded gains relative to price conditions at the beginning of the year. Since January 2023, crude oil prices have registered a 9.1% increase to $88.7 per barrel in October 2023. Driven in large part by concerns about global supply shortfalls arising mainly from the extension of production cuts from Saudi Arabia and Russia. Cocoa prices have risen sharply to levels last seen in the 1970s to $3,603.3 per ton in October 2023. The 41.9% increase in cocoa prices is mainly attributed to mounting concerns over tight supplies in Ivory Coast and Ghana, stemming from adverse weather conditions. Gold prices gained 6.6% to settle at $1,913.79 per fine ounce, largely due to expectations of a pause in the U.S. Federal Reserve rate hikes and demand for the commodity on account of its safe haven status amid heightening geopolitical tensions. There was further improvement in the trade balance over the first 10 months of the year, reflecting the generally favorable commodity prices alongside import compression. The trade account indicated a higher surplus of $2.1 billion for the first 10 months of 2023, relative to a trade surplus of $1.8 billion in the same period of 2022. This was driven by a greater reduction in imports relative to exports. Total imports declined by 8.9% to $11.4 billion, driven by both non-oil imports and oil and gas imports. Non-oil imports were estimated at $7.7 billion, down by 9.3%, while oil and gas imports also declined by 8.1% to $3.7 billion. Merchandise exports also declined by 6.4 billion to 13.4 billion US dollars, and this was weighed down by crude oil exports and cocoa products. Of the total, gold export earnings increased by 13.9% to 6.1 billion US dollars, benefiting from both volume and price effect. Cocoa bean exports also increased by 6.1% to 1.1 billion US dollars on the back of higher volumes. In contrast, crude oil exports decreased sharply by 33.5% to 3.1 billion US dollars, mainly driven by reduced volumes, while other exports, including non-traditional exports, decreased marginally by 1.1% to an estimated value of 2.6 billion US dollars. Data up to the third quarter of the year shows that the current account recorded a surplus of 1 billion US dollars, in contrast to a deficit of 1.8 billion US dollars recorded for the same period of 2022. The surplus was driven by improvements in the trade account, a sharp drop in income payments, and strong growth in remittance inflows. The income account improved significantly on the back of the debt standstill, which led to a sharp decline in net income payments by 56% to 1.4 billion US dollars, and in interest payments on public debt by 89.8% to 134 million US dollars, compared with 1.3 billion US dollars in the same time of 2022. Remittance flows, however, increased to 3.2 billion US dollars compared with 2.5 billion US dollars in the same period of 2022. The capital and financial accounts are benefiting from reduced portfolio outflows and lower amortization payments. The capital and financial account recorded a net outflow of 1.5 billion in the review period, slightly lower than the 1.6 billion recorded a year earlier due to lower portfolio payments and reduced government amortization. In the period, portfolio outflows reduced to 195 million US dollars compared with 1.9 billion a year earlier. Also, government's loan amortization declined by 41.7% to 523 million, mainly due to the debt standstill. Foreign direct investment also moderated to 926 million US dollars from 1.1 billion US dollars in 2022. The favorable developments in the current and the capital and financial accounts impacted positively on the balance of payments. By the end of the third quarter, the trade surplus, current account surplus, lower capital outflows helped the overall balance of payments deficit to 617 million US dollars in the third quarter of 2023, from a deficit of 3.4 billion in the third quarter of 2022. Gross international reserves, excluding pledged assets and petroleum funds, reflected a build-up. The level of reserves, as defined under the IMF program, increased to 2.5 billion, equivalent to 1.1 months of import cover at the end of October 2023, from the December 2022 position of 1.5 billion, that is 0.6 months of import cover. This indicates a build-up of about 1 billion US dollars, driven mainly by the Gold for Reserves program. The above favorable external developments and tighter monetary policy stance have resulted in a relatively stable cedi in the year so far. Excluding the sharp depreciation of 20.6% in January, the Ghana cedi has cumulatively depreciated by 6.6% against the US dollar between February and November 20th, 2023. The relative stability has largely been supported by inflows from the IMF ECF first tranche, the domestic gold purchase program, as well as purchases of repatriated export proceeds from mining companies and oil and gas producers. Summary and outlook. The committee noted that tighter financing conditions, slower growth in manufacturing and services sectors, and China's slower recovery were exerting some moderating influence on global economic activity. Earlier aggressive policy tightening by advanced economy central banks has contributed to the dampening of inflation pressures, with headline inflation decelerating in many of their economies. This has led to a pause in the tightening cycle. But core inflation remains high and is declining slowly due to strong labor markets. In the outlook, central banks are expected to maintain policy rates at high levels for much longer periods to contain the still elevated inflation levels relative to targets. The prevailing higher policy rates, long-term bond yields, and renewed strength of the US dollar could continue to keep global financing conditions tight, with consequences for emerging market and developing economies. Furthermore, rising geopolitical tensions is creating uncertainty about crude oil prices, and full crystallization of this risk could undermine the disinflation process in many economies, including Ghana. On the domestic macroeconomic environment, the committee observed the broad improvements in the economy, reflecting stable exchange rates, the sustained disinflation process, and increased accumulation of foreign exchange reserves. These developments reflect improvements in underlying policies, including fiscal consolidation, the zero financing of the budget by the central bank, and the relatively favorable external conditions. In the outlook, the improvements will be sustained by continued maintenance of tight monetary conditions, sustained fiscal consolidation, and continued reserve accumulation supported through the Gold for Reserves program. On growth, domestic economic activity continues to recover, evidenced by the steady improvement in the bank's high-frequency economic indicators. The CIEA is recovering from negative territory and is likely to turn positive by year-end, showing a more solid rebound in economic activities. Both business and consumer sentiments remain largely stable. Private sector credit growth, however, remains dampened due to risk aversion by banks amid tightened policy conditions and rising credit risk. With continued improvement in the macroeconomic conditions supported by declining inflation, credit conditions are expected to improve, with a turnaround in credit extension to support growth. The external payment position is expected to improve, underpinned by continuous implementation of the IMF-supported program and the Gold for Reserves program, among others. The early completion and settlement of favorable agreements with bilateral creditors and commercial bondholders will help boost confidence and trigger resource flows to the economy. The strong build-up in reserves have provided cushion against external vulnerabilities, including the delay in the cocoa syndicated loan. Reserve build-up will even be stronger by the end of the year on receipt of the cocoa loan and disbursement of the IMF's second tranche. In the outlook, sustained fiscal consolidation will be needed to place the economy firmly on the course of disinflation. The implementation of the budget thus far has been strong, reflecting the attainment of fiscal targets under the program for the first review. The 2024 budget is also designed to reinforce the ongoing fiscal consolidation. Headline inflation has continued to decelerate in the past few months, consistent with forecasts. The latest bank forecast indicates that the disinflation process is expected to continue, supported by the current tight monetary policy stance, relatively stable exchange rates, and base drift effects. All the core measures of inflation and inflation expectations are pointing downwards, and the bank will remain vigilant on risks to the disinflation process. The committee noted that although inflation is decelerating, it remains high relative to target. Therefore, there is a need to keep the policy rate tighter for longer until inflation is firmly anchored on the downward trajectory towards the medium-term target. Given these considerations, the committee decided to maintain the monetary policy rate at 30%. Additional monetary policy measure. The committee also made the following changes. 1. Unify the currency holding for the cash reserve ratio requirement on foreign currency denominated deposits and domestic currency deposits for banks. The new unified cash reserve ratio for total deposits, both CD and foreign currency, are to be held in CDs, and this is being reset to 15%, effective 30th November 2023. This measure is to reinforce the bank's liquidity management operations to address excess structural liquidity conditions in the market and provide additional impetus to the disinflation process. The committee will continue to monitor developments in the banking sector and deploy other policy tools as and when required to support stability.